Good evening, everybody. I'm Rasmeet Kohli, Senior Assistant General Manager, working in the Investor Education Department of NISM. As you are aware, NISM is a capacity building initiative of SEBI, and we at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. So we at NISM work primarily in five broad areas: the long-term and short-term academic programs, certification for market intermediaries, e-learning programs, training programs for working professionals and academia, of course, and various investor education initiatives. So for today's topic, how to efficiently manage subject to market risks, we have with us Dr. Balaji Rao DG. To introduce Sir, Dr. Balaji Rao is a SEBI NISM impaneled financial educator with 38 years of overall experience, in fact, more than 38 years, including 25 years in BFSI and 13 years in training and academics. He holds BCom, MBA, PGD-MM, PGD-FA, and a PhD in mutual funds and personal finance. Mr. Rao has delivered 800 plus investor awareness programs and distributor training programs across India. He has been associated with leading institutions as a trainer speaker, including HDFC Mutual Fund, Aditya Birla Sun Life Mutual Fund, ICICI Prudential Mutual Fund, and Canara HSBC Life Insurance. He is also a co-founder and director of OSAT Knowledge Private Limited. Over to you, sir.
Thank you, ma'am. Thank you so much for the opportunity. And I'd like to welcome all the participants who have logged in today. It's a great initiative to educate common people because most of the time, everyone keeps looking at so many information that keeps barraging across various media and other places, and trying to get probably I would say with confidence that more authentic information, like they say, from the horse's mouth, is what we try to bring in association. I mean, with a collaborate association where I bring my experience into the session and the platform. Of course, NISM is a behemoth in investor education and other education initiatives. So let me start with this particular topic today. See, there's a big initiative done by the market regulator along with AMFI, that is Association of Mutual Funds in India, that what we have seen very regularly is mutual fund sahi hai. That means if you have to translate it in English, you can say, yes, mutual fund is the right choice, right? We all look at that particular advertisement, which comes for maybe 30 seconds, sometimes 60 seconds, and we all have identified mutual funds with this ad, but mutual fund sahi hai. But as a regulatory disclaimer, which is mandatory, which is also very important, which is also something which nobody wants to hide, okay, that your investment in mutual funds are subject to market risk. Read offer documents carefully before investing. So there are two distinct, or I would say, two different poles here. Okay, one pole of this particular globe or a particular circle says mutual funds are a right choice to invest. But at the other end of the pole, it says that mutual funds are subject to market risk. Now the question comes: should I invest? Should I not invest? Okay, so that is why we try to address this particular dilemma, if I can put that term, that mutual funds are definitely subject to market. It's like in Hindi they say, kal, aaj or kal. That means yesterday it was risky, today it is risky, tomorrow it will be risky. So what are we going to do? Are we going to run away, hide from not understanding how the risk works? That is what is the idea or the topic that we have chosen today. And in the given short time that we have, we'll try to explore and try to understand a few aspects about risk. And also in the end, I'll show you, I'm going to make this presentation or talk into two parts. One is that I'm going to show you some slides. Then I'm going to show you some calculations or some performances through Excel sheet, so which I'll try to connect both these things together. And in the end, maybe 10-15 minutes, we'll try to take some questions from you to try to see if we can try to answer some of your queries today. Right? Let's begin. So, how to efficiently manage subject to market risk. All right. Now, see, first of all, what is risk? See, entire life, our existence, human beings' existence actually, okay, is based on risk. Even if you look at animals, for a rat, the cat is a risk. For the cat, dog is a risk. For a dog, human beings are risk. For human beings, we ourselves are, having a lot of risky life. So, what are we trying to understand about risk? Because when we talk about risk, three things are there when we talk about this term risk. One, a decision, because whatever we do in life, including brushing our teeth in the morning, okay, we take a lot of decisions. Some are very mundane decisions, that is very basic decisions that we may not want to take, but it happens cognitively every day, right? But there are some decisions that we take, these are, there can be two outcomes. Okay, now for example, you want to send your child to a school, or you want to find a particular school. You have to make a decision. Okay, which school would be better for my child? So there are two possibilities that may happen, right? There are two possible outcomes, right? There are one outcome is uncertainty. Correct? Now there's a decision, there are more than one possible outcome, and the uncertainty about which outcome will happen. What is that? Which outcome will happen? You thought that was the best school to make your child to join. Your child is going to do extremely well. Your child is going to like the particular school environment, teaching, everything there. That is one set of outcome. Okay, what other set of outcome? You made a very bad decision, that the school was bad, your child did not like it, the teachers were not good, the teaching was not good, but you had to take a decision, isn't it? So when we talk about risk, these are the three things that we have to start with understanding this, because I'm going to connect this with an investment also as we proceed. Because investing also is about a decision that we have to make, right? And there are several outcomes for the when you look at what happens to your investment in the future. And some of the decisions you make, for example, when you put your money in a bank deposit, you're certain about the outcome. Correct? Now, there's no risk that you are taking. But it's a very like brushing your teeth. Okay, there's nothing you have to make. You know that you go to put your money in a bank, put your money in a post office or anything that is assured. You already know the outcome. There's the uncertainty there. But there are certain investment decisions that all of us make in life where the outcome may have different possibilities. Right? Now, in day-to-day examples, because why I'm using these day-to-day examples, you might say, I already know this. Why are you trying to tell us this, which we have been leading this life every day? No, it's very important to we have to create an analogy. Correct? No? Because unless we don't bring real life examples, illustrations to our investment, we will not be able to understand from behavioral point of view that the risk that we take, or we are going to take, or we will take, okay, are we going to take the right decision, right? So riding on a two-wheeler, carrying an umbrella, okay, keeping our money safe. So here, keeping our money safe means I don't want to invest that money at all. Is it not risky? Yes. If you keep 100 rupees in a golden box in your safely in an almirah, after 1 year, if you open that open almirah and open that box and remove the 100 rupees note from that, now what is the value of that 100 rupees? What is the risk there? Your 100 rupees has remained to be 100 rupees. But what happens to the value of 100 rupees or worth of 100 rupees? It would have fallen down because of inflation, isn't it? That is why we need to understand on a day-to-day basis, that what exactly risk means and how are we managing this risk end of the day. Correct? No. I'll show you how to manage this as I progress. Right? Another example is that many parents, okay, when the child comes to class 10, class 11, class 12, there is a thinking, decision making goes on in almost every family, that should my as a child, the child itself is deciding or thinking in a complete dilemma. Should I take an MBA? Should I be a commerce graduate, management graduate? Should I choose an engineering? Should I choose medical? Or should I start my own business? In engineering, if I take, which specialization should I take? Right? Should I take mechanical? Should I take civil? Should I take computer science? Computer science? Should I take AI? Should I take machine learning? What? Which one is going to be the better one for me? Where I'm going to land up a job? What if it doesn't work out? In MBA, should I take finance? Should I take marketing? Should I take human resource? Should I take supply chain management? See, there also a decision. So there are different outcomes. Either your decision worked out as expected by you, or the decision misfired, or decision the outcome was not as expected by you. So in real life, on a daily basis, we are all going through various types of decisions, okay, that has got different outcomes. So we should also remember that risk, is not always negative. Where risk is what? It's about uncertainty. And what is the loss? One possible outcome. Loss is what is at the end of the day? Loss means it is one possible outcome. What is gain? It is another possible outcome. Both are, when you have investing money, right? Two possibilities definitely will happen. Correct? One, either you're going to lose or you're going to gain. Hardly, I would say, in very, 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 very few circumstances that your money will stay as it is, nothing will happen. Right? Otherwise, uncertainty, loss also is an uncertainty, whether it'll happen or not. Profit also is an uncertainty. Right? Again, I want to reiterate that we are learning about this theoretically because you should have a matured understanding about risk. Only then we will understand how to manage risk with investments, right? What is risk end of the day? It's a probability that actual results, will differ from expected results, isn't it? You have one thinking in your mind that this is what. Okay, today I came from Tirupati. Okay, because I had an early morning 5:45 darshan. Okay, I was about 270 kilometers away. I had to come back to the hotel in Tirupati, pick my bag, rush, and then I want to reach home by 3 o'clock because I had to send the presentation. I had to start the session at 4 o'clock. Okay, when I left there, I told my wife, "We're leaving at 9:30. Hope we'll not get stuck with one of the worst traffic that Bangalore city has got, right? In some, various junctions, various bottlenecks. That was risk I took. Now I had taken my laptop with me. See, how did I manage my risk? Right? What is the risk? That I will not reach home on time. I cannot sit in cafe coffee day. I cannot sit in a restaurant. My friend suggested that why don't you sit in the car at the back and then do the session? But I said, I'm going for NISM boss. I cannot do such, shabby work sitting in a car, okay, without proper light and all. I don't want to do that. But I carried my laptop. My wife's cousin stays somewhere on the way, okay, near that Kiarpuram junction signal, maybe a kilometer from there. I was prepared. See, there was risk, that I may not reach on time. But that decision I had to take in the morning because I cannot leave having the darshan of Lord Srinivasa, Lord Venkatesha, But I managed the risk by carrying my laptop, keeping couple of options ready with me that I will not miss the session. So, people, what I'm trying to say is that risk is there in everything. So how do we manage it? Okay, that is what is going to be, okay, the way that we are going to have a mature understanding. Right? Now, risk-led investing. See, I'll start moving towards investing. See, investing, risk does not mean, see, normally when we talk about mutual funds, when we talk about stock market, right, what comes to common people's mind? They think that market will crash. They'll think that the company that they have purchased will shut down, okay, or they will lose their money. This is the common understanding, a common, what can I say, fear that people have got. So how do you address this particular risk that market will crash? I will lose my money, right? So we have to understand risk is not about avoiding it, it is about efficiently managing it. See, I keep telling in most of my investor awareness programs that our Indian economy in the last 30 years, has changed. unbelievably. Okay, because I'm almost 60 years, so 59 years now, running 60th year. I've seen the economy or Indian economy and the dynamics that has changed around me. Okay, from 30th year of my life, 1995, okay, to almost 60th year of my life, 2026. Okay, what is that? 30 years ago, I'll tell you, we are all worried about subject to market risk, isn't it? See, 30 years ago, a bank deposit, you can ask if anyone, people who are participating today are young, in your 30s or 20s or 40s, please ask your father or grandfather who are in their 60s or 70s. Ask them, please tell me, 30 years ago, what was the bank deposit rate that we were getting? Oh, they will say, oh, boss, us zamane mein we were getting 14% yaar, interest rate in the bank. So today, see, we are getting only 6%. Okay, see, that is what is the risk that I'm saying. See, we didn't, common people didn't understand that as economy grows, when economies, how does economy grow? Very simple. Economy grows when we start consuming more. Correct? No. When we, how does a restaurant grow? How does a hotel grow? They all grow because when more people start eating in the restaurant, correct? Na? That restaurant becomes a very successful restaurant, very profitable restaurant, isn't it? How does a school, college become very successful? When more students start joining that particular education institution. That is where the school or college become. You can take many number of examples like that. How does an economy grow then? Economy grows when you and I, common people of 145, 150 crore population, we are consuming. Correct? When consumption has to increase, people have to be motivated to spend. What is the biggest spending, largest spending people do? Buying a house or constructing a house is among the largest expenditure that people do. What is the next largest expenditure people do? Is buying cars. Okay. Now just think about it for a moment. Now, how many people will buy or build a house putting all their cash down? So 1 crore is the house. Will you be able to put 1 crore rupees and on your own? Okay, go to the bank, withdraw the money, and pay 1 crore and buy the house? No. 92% of the construction that is being done in India, all these are actually done on after availing loans. Imagine 30 years ago, fixed deposit was 14%. You know what is the loan rate of interest? It was 18%. And let me tell you, my dear friends, today the house I'm sitting is my house, which I built in 1998. I took a loan of 2.5 lakh rupees to build this house. You know what is the rate of interest I paid? 18% rate of interest I had paid 27 years ago, But today, the same housing loan rate of interest is 7%. Car loans were 1825. I used to work for a non-banking financial company 30 years ago. Okay, 96 to 2000. I was working for a finance company. We are charging 18 to 20% on car loan. Today, what is the rate of interest on car loan? 8%. What is the rate of interest on business loan today? 8 to 10%. What was it then? Again, 18 to 20%. So, last 30 years, we have to keep this history very clearly in our minds that Indian economy has grown, taking the fixed deposit from 14% to 6%, bringing down the borrowing rate from 18%, 7% today. That is why you're seeing so much of growth around us, where consumption increases. Because why I'm giving this example is because today we are earning 6% bank FD. Indian economy is growing. Correct? Na? When economy grows, inflation also will become a very persistent problem because we are all buying. No, demand is there. 365 days, 24/7 demand will be there. Correct? Na? Look at aeroplanes full of people. I went to Tirupati. The roads were full of cars. Finding a parking in Tirupati was so difficult. So many people having darshan. We went to a restaurant last night. Okay, we had to wait for 40 minutes to get a seat in a restaurant there for our dinner. See, this is what economy is seen around us. Okay, now when consumption increases, inflation also will be difficult to manage. Government wants to keep the inflation down. Government wants people to have a low inflation, but it is easier said than done. Okay, it's like telling, oh, I want my children to listen to me. This is what you want as parent, but will the children listen to you? No. Like that, I want to bring the inflation down, but I'm trying my best. So what has happened in the last decade, 2 decades, inflation and the risk-free interest rates are almost the same. So if you invest in a bank deposit today, assured returns today, and earn 6% rate of assured return from that, any investment for that matter, immediately don't be happy. Abba, I got 6%. Pa. See, what is the inflation? Look at now whether your returns are inflation friendly. You are not managing risk here. Correct now? Because the rate of return is 6%, inflation is 6%. What did you earn? Isn't it risky? Exactly. So you have to identify the hidden risk. Okay, when you are making investment decisions, and we also should remember that no asset class in this world are risk free. It is all our thinking. It's all what we think is risky, what we think is not risky. For example, somebody wants to jump from an aeroplane. Okay, somebody wants a bungee jumping, somebody wants to climb Mount Everest. Do you think it is risky for them? And no, man, I've done 20 times. Somebody doing scuba, my friend Renu, she does scuba diving. Okay, she goes to some 100 feet inside the water with that gear, and she comes back. For her, it is not risky. So risky. What you tell me to go and do bungee jumping, I'll say no, 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 no. I can't do. You tell me you jump from aeroplane, do some skydiving, I'll say no, 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 pa. I can't do that because the language of risk is different for me, different somebody else. Correct. So when you say bank deposit, the capital does not grow. Have you seen your capital growing in a bank or any assured return? No. See, bank deposits, post office savings are there to protect our wealth. They are not designed to create wealth. Okay. As the economy grows, starts losing its ability to beat inflation. That is why government has given us so many other options. Okay. You cannot say, oh, boss, bank deposit rates are coming down here. How will I survive? No. If your deposit rates will rise, loan rates also will rise. You are happy because deposit rates are high, but a person who wants to borrow is unhappy because he or she cannot afford to take a house, buy a house, build a house, or buy a car, buy a two-wheeler, or even start a business because rate of interests are high. So two people, same concept, interest rate. Somebody wants high, somebody wants low, but government wants growth, isn't it? So the options given to us, we need to be very careful. When we say assured return, we have to first understand, is it designed to create wealth or protect wealth? Is it inflation friendly? Then comes gold. Yes, I'm sure most of you and most of the country people are going gaga over silver and gold. Correct? What are that? Oh man, I should have bought silver last January. Today I would have become a crorepati. I should have bought gold. I would have become a crorepati. Nobody told me silver will rise. Nobody told me gold will rise. Fantastic, yeah? Why should I know that something will rise? Not necessary. Okay, we are not Nostradamus. We are not astrologers. Okay, we are not pundits to know what is going to happen tomorrow. In hindsight, I would want to born as Amitabh Bachchan. Okay, hindsight, but it doesn't happen, isn't it? See, gold, it is definitely a risky asset. We have seen gold prices rising. Okay, gold price, anything that has a price has to fall. Na? It's a possibility of loss. You may not have experienced that loss is a different matter altogether. But you understand that prices of gold, silver, any commodity or any asset, they will fall also. There's a possibility of loss. And the second most important aspect of risk is it is emotional. What is emotional? Will you sell gold? Will you sell silver? Will you sell precious metal, jewelry? No. Even if you have 200, 400 grams of gold with you, silver with you, when will you sell? Correct? You will say, I'll sell when bad time comes. What is that bad time? People say, oh, for medical emergency, we'll use. No, medical emergency, you should not use gold. You should not use precious metal. You should not break your FD. You should not sell your mutual funds. Buy proper health insurance coverage. Having 3 lakh, 2 lakh, 5 lakh health insurance and say, catastrophe happened, I had to sell my gold. No, my friends, please don't get into this kind of thinking that you are going to get into catastrophe and you are going to sell gold. Correct? How much of gold will you keep? When will you sell? When will you liquidate? You are going to become asset rich and cash poor. You got so much of gold with you, but you still don't have cash with you. And storage value, you are going to just lock it in your almirah, lock it in your safe deposit locker, or go to a bank, pay some annual rent and store it there. Not that you should not invest. You should invest in all assets. That is what is the power of asset allocation. But how much are you investing in each? What's your exposure to each asset? That is what defines you to be a good investor. Real estate, you're also many people, we don't acknowledge. My own friends and relatives have lost a lot of money with real estate. They made bad investments in real estate. Okay, there is no such hard and fast experience or rule that all real estates in the world have given profits to people. No. Secondly, you cannot sell real estate in smaller portion. Let's say you got a 1,000 square feet property. Can you sell 100 square feet, 50 square feet? No, we cannot. And is liquidating easy? No, liquidating is not easy. You have to pay capital gain tax. You want to avoid it. You have to reinvest it in another year capital gain bonds. Where is your cash? So we need to, again, should I not invest in real estate? No, you can, you should, you must. But how much? Are you overexposed to a single asset? That is what is bad. We are trying to explain. Now, what about life insurance? Life insurance has opaque. What is opaque product? You don't understand how it works. Okay, very the way it has been designed. Okay, it will give you some money at the end of a particular maturity, no doubt about it. Okay, but understanding life insurance products, are not easy. Okay, they are illiquid. You have to hold it for a pretty long period of time without having an option to exit. And everybody knows that the return that we get on long-term life insurance are also poor, right? So all assets are there, but every asset has got its own pros and cons. Okay, that is what you have to must understand from this. Now I'll come to equity. See, I'm not going to tell you equity is not going to hide anything. I've spent 32 years now in stock market. Okay, books related to stock markets. Okay, now I don't want to beat around the bush and say yes, equity. Okay, why equity is risky? Because the price of a stock or prices of stocks are uncertain. What is price uncertainty? You don't know whether the price will rise or price will fall, or you don't know, or common people don't know at what price to buy. And there are business uncertainties. What is business uncertainties? Will that business grow or doesn't grow? Will something happen to the company? Will that company survive at all? You have, see, I'm sure you must have experienced in your life or in your investing journey that some companies, okay, I don't want to name any companies here. Okay, that's not my idea of talking about specific companies. I'm just telling you as an asset class, right? There are some businesses who cannot do well continuously because every business goes through but ups and downs. Like our life, our life also goes through ups and downs. Like that, business also goes through a lot of ups and downs. And many times, some businesses, despite all the effort done by the promoters, still the companies shut down. Or some promoters may not be having good intention, or they become overconfident. Okay, some businesses, shut down, close down. What to do? That is uncertainty of anything in life. Extreme uncertainty is related to equity. I agree with you. Are returns assured? No, returns are not assured. Can you predict? See, normal question people ask, it's what will I answer? Again, I should be Nostradamus, should be an astrologer to tell people that how much return will you make. The return is an outcome of your goal. Return is an outcome of what you choose. Return is an outcome. How long will you stay? and various things that is working around you. Correct now. See, today I left at 9:30, reached home exactly at 3 p.m. because traffic was good. Easy. The roads were good. I did not get stuck in serious traffic situations today. I was good today that I reached. My wife's sister's husband. They also went to Tirupati about 10 days back. They went on 2nd and 3rd of this month. Took 3 hours from Bangalore outskirt to reach. I reached in 1.5 hours today. They took little over 3 hours to reach. See, uncertainty. So will you tell when will you reach? Cannot say. I approximately. This is what. So yes, we cannot predict. So let us not get into this. Will market go down? Will market go up? Will I lose money? Will the return come? No. There is no such thing as prediction in stock market. Right? Is equity difficult to understand? Is life easy to understand? I will say yes and no. Like that, equity also is easy to understand, right? I will say yes and no. Maybe it is easy. Whenever, whichever stock I buy, the stock price went up. Oh, easy, man. I made money, right? No, the stock prices fell down. Oh, I lost money, man. Oh, equity is difficult. See, two, one stock, okay, two different outcomes can make me to say different answer. If I'm happy with the returns, if the results are positive, I will say yes, equity is easy to understand. If negative, if the outcome led to a loss, what will I say? Oh no, man, equity is very difficult to understand. But I would say many people have asked me, sir, which book I should read, okay, to understand stock market. Okay, which book will you read? How many books will you read? There are so many authors, okay, who have written so many books. Okay, across the world, thousands of books have been written related to stock. In India only, you will find hundreds of authors written hundreds of books about stock market. Now, which one will you read? Who is right? Whose rendition of the book is true or correct? Correct, you can say. But that's why I'll say make. I'll try to make this equity so that you understand how to manage risk. Right? See, all you know correct. Every day we consume so many products. And sir, when you are at a petrol bunk, okay, you are actually, what are you doing? You are trying to buy something. When you are at a bank, we are doing? You are trying to get a service, a particular bank. When you are using a mobile phone, what are you doing? You're getting a service from a particular mobile company, isn't it? So the tooth, the soap, shampoo, gas cylinder, clothing, car, two-wheeler, the cars you drive, next time when your two-wheeler fitted with, you'll be surprised to see the names of those companies. It could be MRF, it could be Apollo Tech, it could be Seat, it could be Dunlop. The paints that you use to paint your house, it could be Asian Paint, Berger Paints, Nerolac Paint, Shalimar Paint, Nippon Paint, Indigo Paint. The cement you use, the visit for our normal banking transaction, the footwear we use. See, every product we use, they're all part of stock market. What are these companies? These companies are creating product and service for us to consume. Our consumption is their business, isn't it? Everything that we consume is stock market for you. Companies in the stock market. When you go to a medical shop, you buy medicine. Next time when you buy a medicine, turn that medicine sheet and check. Or when you buy a tonic, okay, syrup, you take a syrup and just turn and check which company has manufactured. You'll be surprised to see the companies that are maybe Cipla, maybe Dr. Reddy's Laboratories, maybe Sun Pharma, maybe Glenmark, the Boost, Bournvita that we drink, Complan, we drink the Maggi noodles we eat. What are all these? Correct? All these, there are. So you will find tens and hundreds of companies under pharma. You will find tens of companies in cement, in paint. These are put together. There are about 5,000 companies who are listed on a stock market, what is called as a stock exchange. It could be the Bombay Stock Exchange or the National Stock Exchange. Two stock exchanges we have got. Companies will raise money through common people like you and me, institutions, equity money, and they try to say that I'm using your money, pa. You are my shareholder. You are owners of my company. I am running your company. See, this is how I run my company. So they try to utilize the capital given by common people like you and me, shareholders, right? So they have to showcase what did I do, how did I do this particular month, this particular quarter, this particular year, and what about those companies, and what is general move in the market. All things will define the stock prices rising up and rising, going. There are 5,000 such companies in the stock market. And I'm telling you, in your house, just take one small, tour of your whatever products are in the house, maybe your rice cooker, maybe your gas cylinder, maybe the gas, stove that you use, the shaving cream, shaving brush we use, shaving blade we use, the matchbox we use, shampoo, soap. You just have a look at the biscuits you have in your dabba in your house. You will understand that, oh, this is what is stock market, is it? Yes. Stock market is very simple to understand because we are the consumers of those companies, right? But when 5,000 companies are there, though we want to enter stock market or you have entered stock market, many of us, what is the problem here? We start thinking which stock to buy, at what price to buy, because risk, no, correct? If I can I buy this stock, what could happen? Will I make money? Will I lose money? See, there are two outcomes of that particular risk. What price to buy? Is this price the right price? What if I'm buying at a higher price? What if I'm not buying at a lower price? See, again, the risk will start happening. Then comes when, if I sell today, what if the price falls down tomorrow? What if the price doesn't rise tomorrow? What if, if I didn't sell yesterday? Okay, oh, today the price fell. Oh, I fell. I sold it, but the price went up. See, and the price you will see, array, this is such a good rupees. My God, I cannot buy it. Mark is per share. My God, I cannot buy it. What will you do? See, look at all those common risks there for the common people when it is stock market. That is why we are trying to know more. What is that? Focus on risk. Okay, common people putting more focus. So, how do you find a solution to this? The solution is outsourcing. See, whatever I'm not good at, okay, we try to get it from outside, isn't it? Electrician, plumber, a civil engineer, a AC repair person. See, so many outsource it, We are looking for a specialist. We're looking for an expert where we want to share the risk and return when it comes to investing. See, when we travel by a bus, train, or aeroplane, we are completely the pilots because they are the outsourced specialist experts. Correct? We sit in the bus, we sit in the train, we sit in the aeroplane and completely depend by sharing the risk and destination, right? With 100, 200, 300, 1,000, 2,000 people. Correct? So when you're outsourcing, we have to diversify. I'll show you what is diversification in a moment. And low investment, can I put less money and buy more? Because we all want like that, isn't? That's why we do go to sale less and buy more. And also the management cost is less. What is the solution for this? See, now we are trying to understand how to manage risk. See, you can see this boy here. He is in a deep water, I guess. What is that person boy wearing? That boy is wearing a life jacket. See, some market risk means you are trying to manage this. You might sink. You don't know how to swim. Or even if you know how to swim, you don't know it's very deep here. I feel very risky. See, wear a life jacket. When you are driving, we wear a seat belt. Correct? When we are riding a two-wheeler, we wear helmet. When there is rain, we take an umbrella. Like that, we do so many things, in our real life. Because managing risk is the only way we understand the or respecting that risk is there. I'm not trying to avoid the risk, but I'm trying to manage the risk. See, now we move to the last leg of our understanding. What is solution for managing risk? It is mutual funds, where there are set of people, group of mutual. See, when you take a housing loan, when you take a car, let's say you took a 50 lakh housing loan, you took. Whose money did that bank give 50 lakh rupees? Thousands of depositors who contributed 5,000, 10, 20, 30, 40, 50,000 rupees together, isn't it? Their money was collected, mobilized. That money was given to you as a loan, isn't it? See, mutually, all those people wanted to earn interest. So they put that money there. See, there also it is mutual. In aeroplane, we all sit in a theater, watch movie, a single movie. See, mutually we have contributed. So in mutual funds also, many people, there are mutual fund companies, just like a bus company. Okay, like a bus company operates an aeroplane. SpiceJet is there, Akasa Air is there, Indigo is there, Air India is there. What are those? They are all vehicles. Like there are several mutual fund companies, and there are air there are crew members, correct? Now, like that in mutual funds, there is a mutual fund company like an airline company. There are pilots like fund managers. There are other support staff who are called as research people. Okay, they were called as analysis people, support staff. See, this is how. What will you and me do? Boss, I don't know which stock to buy. I don't know what price to buy. I don't know when to sell. I don't know how to do research. So can you do? I'm going to pay you a small fee, or we are going to pay small fee, because when many people get together, your fee also will start reducing, isn't it? Correct? So the fund, what does the fund manager do? The fund manager is the expert. Why is he expert? Each of us are an expert in something other in life, isn't it? And he or she expert in managing the securities in the debt securities. It can be equity generate. I'm not telling they will generate. They will try their best, just like a bus driver, pilot will try their best to reach you as a passenger safely to your destination, isn't it? Similarly, here also, the fund managers are her best to see that given all the volatility, given all the uncertainty that is there, market's uncertain for you, uncertain for a mutual fund company and a mutual fund manager. But still, they try and manage all these things to the best of their abilities, right? To generate returns. Again, returns are again shared by many people, right? Now, mutual funds, why was in 1963 the government of India introduced mutual fund through a parliament decision? Why did the government introduce mutual fund? Because they wanted people to start getting into the formal financial market. If not directly, they have to start coming indirectly. They don't have to manage the risk directly. We are going to give them a managed risk management method of investing is what mutual funds were introduced. So there are range of categories. There are I've given mota okay categories. I'm sure when you meet your mutual distributor or advisor, you'll be able to get more information from them. There are debt funds, which is to preserve wealth. There are hybrid fund, which is to balance wealth, a mix of equity and debt. There are equity fund that is there to create wealth. There are multi-asset funds. Now, to multi-asset funds, because of the gold and silver surge in the prices in the last couple of years, these commodities are making headlines. So, multi-asset funds are such funds where the fund manager will capture all the three asset classes in different proportions: equity, debt, and commodities. So these are the broad range of categories that are available. Right here, why would you choose the debt fund? See, up to 5 years of your money management. Okay, you need money. You don't need the money. You have some money, but you don't need it for the next 3 months, 6 months, to 8 months, 9 months, 1 year, 2, 3, 4, up to 5 years. You should ideally choose debt funds. See, equity. I'm not even taking that particular word at all here, because equity is meant ideally for holding for beyond 5 years. Okay, you are in a hurry. Market or mutual not in a hurry. Just because you are in a hurry honking, the road will not become shorter. No. Many people keep honking when we are driving, or they try to go fast, okay, overtaking you. Why? Because they're taking risk unnecessarily. So, when it comes to invest, so equity requires time. If you are in a hurry, equity cannot do anything. Okay. Again, we are not here to book profit. We're here to create wealth. So don't confuse between profit booking and wealth creation. Your 100 rupees becoming 110 rupees is profit booking. Or 100 becoming 200 is wealth creation. Don't forget the difference ever. Okay. Then hybrid funds are a mix of equity and debt where it tries to balance the wealth. Equity is to create wealth, and also multi funds are there to create wealth. All right. Now, for investing methods, see, we have got 4 investing methods: lump sum, which is one time, just like bank deposit, minimum is 5,000 rupees; SIP, systematic investment plan, it's like recurring deposit, investing a specific amount every month on a specific date for a specified period of time. Minimum is 500 rupees per month. Systematic transfer plan, when you have a market view that the markets may not be rising, it is your view. Okay, again, it is not a common view. You may think that I have some 10 lakh rupees with me, but I want to invest, but I don't want to invest full money today because I think the market may not do well in the foreseeable future or as per your thinking. So instead of entering investing full money in equity, you can park the 10 lakh rupees, for example, in a debt fund and instruct a specific amount, regular amount, to be transferred from debt to equity over a particular period of time. This will work when as expected by you. If the market starts going down, it will be a good decision choosing a systematic transfer plan. Then comes systematic withdrawal plan. This is the one investment method. It is getting a lot of attention these days because of interest rates are going down. People want to, old people, particularly retired people, want to generate something more, cash flows for themselves. What SW means, ideally suited for post-retirement cash flows, where you invest a lump sum money, okay, in a particular fund, category of fund, I would say, and then try to withdraw that money. Okay, 1 second, hold on.
Until that time, attendees can start typing in their questions in a Q&A section so that sir can answer those questions later on.
You can put some money in a particular category of fund and try to get some regular cash flows. Okay, you can. We recommend that you meet a financial distributor or an advisor to help you with that. Okay. And mutual funds, you get various categories, and each category is for a different type of investor profiles. Okay, based on the risk and holding period. Okay, and equity, you will find that there are very categories. I'm sure some of you who have been investing or who know something in mutual funds, you already are aware that there are certain large cap fund, mid cap fund, small cap fund, multi cap fund, and all. It's an easy picture is what graph that we have given here, where you can see the arrow mark. Each category will have its own risk intensity. Okay, it starts with index fund, where only a predefined 50 stocks will be there, and then you will find, as the risk, as you go, see, remember I told you 5,000 stocks, correct now? So as you go inside the market, as we start picking more and more stocks between large companies, medium-sized companies, small companies, risk also will start increasing. So you need to be mindful of, when you are selecting, you have to always decide what is your risk profile and what are you choosing. Okay, that is where you can try to understand that this is how, or this is the kind of category that suits my type of risk profile. So don't chase returns end of the day. Okay, returns is an outcome of how you choose to invest, okay, or what you have chosen. But chasing returns, okay, is not a good way of becoming a successful investor. Okay, now I'm going to show you one last example of how risk can be managed, and then I'll take any questions you may have. See, this is very vividly we'll try to understand what is the meaning of subject to market risk. Okay, I'm not going to show you the entire what is that return. I'm not here to show or try to convince you about what is the return part of it. But I'm just going to show you why prominently it is displayed subject to market risk. Okay. See, I'm showing you a real-time example because my PhD was done with some similar data of this, okay, which I try to analyze certain outcomes, hypothesis during my PhD. Okay, that's why I use this for a simple understanding. See, in 1995 January, somebody started putting 1,000 rupees per month through a systematic investment plan for the retirement. Okay, again, I'm taking a long-term goal here. Okay, I don't want to confuse you in the sense that how long should I invest? See, I have taken an example of a long-term retirement as a goal. Correct? Na? Many of us they will struggle for trying to create retirement corpus because retirement is the only uh, corpus for which you cannot take a loan. You can take a loan on housing, loan for car, loan for medical, loan for education, loan for everything and anything you can take a loan. The only event in our life we cannot take loan is for retirement. Okay, so we should never ignore that because you have to live 30 more years, isn't it? When we retire at 60, we may live for 30 years. How do we manage that risk? Investing is not the risk. Managing your life with adequate money, that is what we have to be trying to understand. See here, 1,000 rupees per month invested for 12 months. Let's see what happened in 12 months. Okay, see, this is what happened after 12. This is a real example. See, that is why prominently it says subject to market risk. Okay, 1,000 rupees per month you invested, 12 months you invested, you saw a loss of your investment, your 12 became 10. All of us are used to investing in bank deposits, where we have never seen our money going down or never seen our money in a depreciated mode. Correct now. But here, mutual fund, because it is not designed for you to offer you a specific return or designed to offer you returns in the short term. Okay. First year, you lost. Now you have got two options to do now. Either you continue waiting for good times will happen, or you will stop investing and say, I will take my money out. I cannot bear this anymore. Right? If you decide to continue for the next 2 years, the next second year, let's see what happened end of second year. See, end of second year, your losses increased, subject to market risk in full force. Your 24,000 became 16,000. Now, what do you do now? Again, you should have a very open heart, not surgery, open heart. You should have a completely, matured thinking in your mind that yes, I'm not going to, flinch. I'm going to, wait because equity investing is not short term, is not meant short, it is for long term. Okay, you have to start making yourself very clear. Second year also you lost. Now let's see third year what happened. See, end of third year, your investment is still loss have come down. Your investment has still showing negative. 36,000 rupees is still not given any profit. Now what do you do? Okay. Now the question is, what happened in these 3 years? See, you started at 9 rupee 29 paisa. Correct na? Net asset value. How many units you purchased? You purchased 107 units is what you purchased. Okay. On that NAV. Now when the net asset value fell to 7 rupee 19 paisa on the 12th month, how many units did you purchase? You purchased 139 units. See, your number of units increased because NAV fell due to market fall, because net asset value is a derivative of market. Correct now. If market doesn't go up, your net asset value will not go up. If market goes down, NAV goes down. Correct now. Now let's come to 24th month. See, on 24th month, net asset value dropped further to 5 paisa. Okay, that means almost 50% loss in your net asset value. But look at number of units you got. See, whenever market fell, your number of units went up. See, couple of years ago, onion went up to 200 rupees per kilo. How much did we buy? 100 grams, 250 grams. That's all. But when onion has today become 20 rupees per kilo, 25 rupees per kilo, how much are we buying? We are buying more, isn't it? So in stock market also, these kind of, or in mutual funds also, these kind of opportunities or these kind of happenings are very common. But how do you define? How do you act upon it? How do you think about it? Define. So I'll quickly show you how net asset values will see. It fell to 6 rupees 40 paisa. It increased, recovered. Look at fifth year, it recovered 20 rupees. Again, it fell to 18 rupees. It fell to 15 rupees. Again, recovered. Okay, recovery. 30 rupees NAV, 54 rupees NAV, 61 rupees NAV, 70 rupees NAV, 104 rupees, 137. Again fell to 104 rupees 85 paisa. Again increased to 150, went to 220. Okay, look at net asset value in January 2020, sorry, 2008. NAV was 220, but after 15 months, NAV fell to 93 rupees, 60% fall. But after 6 months, again, it has recovered back to 220. Don't forget. Okay, see, again, it went to 300, fell to 228. Again, it recovered back to 275, fell to 248, recovered to 300, 400, 488, 370. Look at COVID. In COVID, what happened? January, nobody knew in 2020 what is the meaning of COVID. The NAV of a particular fund was 676 rupees. See, due to COVID lockdowns, it fell to 478, a 40% loss down. But it recovered back in 6 months to 695. So, people, the idea here is not to check how much I made return end of the day, but your destination, but your journey, don't miss that journey. Don't be in a hurry. Don't panic. Market risk is there. There is no doubt about it. It will continue to be there. But are you there? Were you there in that journey? Panicking and getting out money or feeling very happy and taking the profit out of it will not create wealth, my friends. Okay. So the idea of subject to market risk is to try to understand that this investment is risky. Its nature is to be risky, but how am I going to manage that risk? So mutual fund gives you that option to manage that risk because you're not directly entering the market on your own. There are systems that through mutual fund companies, through fund managers, and through a very robust regulator, that is SEBI, Security Exchange Board of India, which oversees with the main motive of protecting common investors' interest, right? And this industry has grown to become 80-85 lakh crore worth of money is being managed across 7 to 8 crores worth of investors are coming, but the only thing haunts their mind is that subject to market risk, subject to market risk. Yes, there is risk, but I'm sure all of you will try to understand how to manage the risk than trying to avoid risk, right? Thank you so much for your time and opportunity. There are some questions, I think I'll try to take those questions. Okay, so demand and supply equal ho to kya kare? See, demand and supply equal kabhi kabhi hota hai, sir. It is not, no, sorry, madam. It is not that demand supply will not be equal. Okay, demand supply on a daily, you go to a petrol bunk, for example. Okay, demand supply is there every day. You see vehicles going there, putting petrol, diesel and going out. Again, somebody going. So the company is able to manage, okay, that supply of, petrol and diesel. Supply of milk, for example. You will find supply of milk is every day, it is normal, correct, equal. That is why you will not see a price increase of these things on a daily basis. Correct. Now, why will you suddenly see increase in vegetable prices? Why do you see sudden decrease in vegetable prices? Because on one particular day or one particular period, the supply shrinks, demand goes up. During festival season, demand increases. The discretion to buy, okay, will be different on those days. Correct now. So some products at some particular point in time, demand supply will be almost matching each other, where you will not find a significant variation in the prices. But when that particular barrier breaks, either there is more supply or more less supply, more demand or less demand, then it leads to price fluctuation, right? Now Mr. Srinivasan has asked, what is invest psychology? So psychology is now. See, the subject to market risk is something. See, I keep joking about this many times. That common people, what we do, we go out in the morning, don't wear helmet, jump signal, go in no entry, okay, do all sorts of risk we take. Okay, we're using mobile while we are driving or riding a two-wheeler. Is it not risky? It is gone as the same person who is riding without a helmet using a mobile, okay, and jumping a signal must invest in equity here. It is subject to market. Will that person invest? He will say, no, 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 no. Oh, yo. I can't lose my money. That person is willing to lose his life, but not lose money. That is what is called as investor psychology. Okay, same that lady I told, Renu, no, she's a scuba diver. Okay, why I take her example often is that because she takes risk. Okay, in a year, almost 6 months she's under the water. But I tell her, Renu, why don't you put money in mutual funds? Is it assured, Balaji Rao? No, Renu, it's not assured. I don't want to take risk. I don't want to take risk with money. Invest psychology again. Okay, so invest psychology stems from what you perceive things as. What is not risky to you, though it is risky. Driving at 150 km speed, you will say it is not risky. But investing in mutual funds, oh, no, 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 I lose my money. I can't risk. That is what invest psychology. Okay. What type of mutual fund selected or which are the criteria? See, mutual funds, simple, since we get only 1 hour to talk on mutual funds, okay, because again, people are scared. Okay. I'm sure NSM also will be worried. Will people come? Will people stay for 1 hour? That's why we keep only 1 hour. Though such a vast subject has taken me 30, 35 years to understand one small aspect of this particular wonderful market. See, first of all, you have to understand mutual funds. There are three types of companies in the stock market. Okay, one is 100 companies are large size companies, 150 companies are medium size companies, and balance. Okay, about 4,000 and odd companies you can say, but I'll take another 250 and odd companies as small size companies. 100 large, 150 medium, and 250 small. Okay, I'll just keep 500 as my universe currently. Now, what is large cap? Like Virat Kohli, Rohit Sharma, Jasprit Bumrah. Okay, these are all called as large cap. Okay, you don't have to worry about them. They're already there, set experience, set people. Even if they don't play, you are still happy to have them in your team. What are mid cap? You will say Rishabh Pant is a mid cap. Hardik Pandya is a mid cap. Okay, no, Varun Chakravarti is a mid cap. Okay, they are not yet become very big, but then the process of becoming big. Okay. Tomorrow, Abhishek Sharma may replace Rohit Sharma. Correct na, in one day team. SSV Jaiswal will replace. See, they're all mid cap players. Okay, medium. Now there are small cap players. Okay, Ravi Bishnoi. Okay, I'm just off the hook. I'm taking example. Okay, you will find Zubendra Chahal, for example. Who are all these people? Vaibhav Suryavanshi recently. These are all small cap. They're all risky players. They may succeed, may not succeed, but large cap, large cap companies already set. L&T, Hindustan Unilever, Asian Paints, ACC, Reliance Industries, HDFC Bank. These are all set. Now you decide. You are okay to invest in large size companies only, or you will say large cap companies are okay, no fun in that. I already know these companies. Can I take a little bit more risk? You have to add some mid cap into it. You'll say, mid cap is okay. I want to take a little bit more risk cap. It's okay. I don't mind. You have to add small cap. So let's say you want to put a mix of large, mid, and small, okay, to balance out the opportunity. I'm not taking risk. You're not balancing risk here. You're balancing the market opportunities, for example. Okay, what should you choose? So that is why mutual funds have separately large cap funds, which suits only those people who don't want to go beyond 100 stocks. Correct. It's like eating masala puri, pani puri. That fellow will ask you, tika kitna chahiye? Tika zyada chahiye? Tika kam chahiye? Tika medium chahiye? I eat medium tika. My wife eats too much of spicy or high spicy, I would say. Like that in mutual funds also, if you are choosing only large cap, you are taking you are a low risk investor. You will say, I'll choose large and mid. I'll choose. Okay, I'll choose. Then you will slightly your risk profile. You will say, I'll choose all large, mid, and small. You are upping your risk to the next level. So, how to choose a mutual fund? Large. You keep in mind, sir or madam, Debashi strategy. Ji. Okay, so you will large, mid, small. That is your universe. You choose whichever category makes sense to you. A mix of that is probably a flexi cap fund where the fund manager can move across large, mid, and small companies comfortably. or a multi-cap fund where almost equal portion of large, mid, and small are invested in a portfolio. So it's up to you to take a call. Easy to actually, like I said, if you look at categories and understand large cap, mid cap, small cap, it becomes easy for you to decide and choose is what I think, sir. Can I insure against risk? No. Why should I insure against risk? Why are you scared of losing money? Okay. If you are, don't ask, can I insure? I think it's a very defensive question to ask, I don't, very difficult to answer. Okay. Should I insure my, there is no, see, speculative risk is not insurable, So you need to, take a call on that. Real estate, no, I don't think I'll take question on real estate. Thank you, Vishnu Prasad Sharma-ji. How much the corpus was in the PDF you just showed. I'm interested. So how much? No, I don't want to anonymous attendee. No, I don't want to, because I don't want to show returns and try to create this one that so much returns can be made, so much of money can be made. It gives a false hope. That's why we normally avoid showing the corpus. Though the corpus looks tremendously wonderful. Okay, for anyone. How to take risk in stock market? How to risk means, see, you should see any risk. You should calculate risk is very important. Okay, risk taking is good actually. Okay, so, for example, you want to climb Mount Everest. Already risky now. You just don't go tomorrow morning. You just don't go there and start climbing it. How do you do that? You understand the weather. You understand which season I should go. What all things have happened in the past. In the month of February last year, what happened? 2 years ago, what happened? Right? What gear will help you to go? With whom should I go? Should I go with a guide, or should I go on my own? Like that, in stock market also, it is already risky. Why it is risky? The company may not perform after you buy, or you are in a hurry to make money, but company is not in a hurry to prove to you that we are a good company. Second, for whatever reason, God forbid, the company may shut down in the future. So how should you understand, enter stock market? There is adequate research available, okay, to understand the company sales, company net profit, company debt equity ratio, company's price to earning ratio, okay, what are their products, who are their competitors. Everything is available today. Go to the company website, go to various forums that are available today. You will get adequate information so that you reduce your risk taking capacity. Sorry, you are reducing your risk. You are not nullifying the risk. But let me tell you, to learn swimming, you have to jump into the water. You have to get your hair wet, get your body wet. You can't stand outside the swimming pool and say that I want to swim. I'll give you a lecture on how to swim. No, get into the water. No, drink a little bit of water. It's okay. Okay, but wear a life jacket and probably jump into the water. Okay, once you start getting more comfortable, understandable about the stocks you buy, reading newspapers, business newspapers on a daily basis, can help you to understand how to take risk in the market. See, investing in ETF, I wouldn't say it is good or bad. ETF is a no nonsense investment vehicle, is what I say. See, exchange traded fund, it is a predefined set of stocks that are there already in a particular box, okay, in a particular jar, I can say. Okay, in active funds, when you're looking at a actively managed fund by fund manager, they have no restrictions on number of stocks. Okay, they can have 50, 60, 40, 70, depends. Okay, they can move in and move out. They can get out of a stock, increase the quantity of stock, percentage of exposure. They are free to do at their discretion. But ETFs are passively managed. There is no need for a fund manager at all there. Okay, there is only an overseer. Okay, maybe a CCTV camera, that's all. For ETF, where the predefined set of securities already present. The movement of the ETF depends on the prices of the particular stocks inside that. Okay, if you want to invest in an actively managed fund where you want to generate an alpha. Alpha means achieving return over and above the risk that is there. Or you will say, no. Why should I want to go through an actively managed fund? I want to stay with the inactive or passively managed fund. You can make those choices. It is not something is good or bad. Something what you believe in, actively managed or passively managed. That is what I think will give you more easy way of doing. Now Lalit Narang is asking direct or regular. See, I'm not a promoter of either direct plan or regular plan, a personal piece, because I'm not an advisor or something like that. I'm just a trainer. See, but my investment, to be honest with you, I've done it through a particular distributor. You know why? See, there is something called uncle point in everybody investor's life. I'll tell you what is uncle point. See, most of the time in our life, we get into some particular, see, Google Map, Google Map will help only to one particular extent. One particular time, Google, maybe there's no network, maybe your Google Map went offline, or you're not able to get that through Google Map. What will you do? Uncle point will come. What is uncle point? You have to get down from your vehicle, go to a particular shop or a person nearby. Sir, can you please help me how to reach this particular destination? Correct now. In investing also, we are all going to go through some uncle points in our lives. What is uncle point? That your investments have got into losses. I've seen 4 market crashes in my life: 1992, 2000, 2001, 2008, 2009, 2020. I have witnessed, having worked in the industry all these particular time, I've seen what exactly is the meaning of a market crash. And when it happens, I know how many people who have come and cried on my shoulder. This shoulder, people have cried. Okay. What should I do, sir? So, direct and regular, direct gives you, has got no leash. What is leash? What are you investing for? When I'm doing a regular, probably I'm going through a particular expert who is going to understand why I'm investing. I need to create 6 crores when I retire. How will you calculate 6 crores? How will you choose what kind of categories fund that I should be investing? Tomorrow when I die, who is going to take care of transferring that money to my successor? I can't use a call center, to do all my job in life. Okay, so it is up to you to decide. Okay, just by paying something extra, okay, to your to a distributor or an advisor, they're not going to eat, because the expense ratio itself is 1.5% per annum on an average. A distributor may take 60, 70 paisa out of 1.5 rupees, and demand a service you are expecting, So I would say that I need a point where I want to ask an expert. Okay, when I'm doing direct, nobody helps me. I'm going to take advice from my brother who is having no experience about stock market. Take some third party person who know anything about market. I would rather ask somebody who knows what to answer, how to answer. And most importantly for me, tomorrow when I'm not there, I don't want my family to run and try to, and where are you? This document, that document not there, spelling mistake is there, this is there, that is not there. I can't give you the money. No. So, and I also want a guide who will tell me, boss, sir, this is your age currently, this is your expenditure currently, this is your inflation that we can consider. So, what based on this, you need so much of money. I will help you to create that particular corpus. I'll walk along with you and ensure that you're going to get that much of corpus. Children education, various goals are there in life. So, somebody who is able to help you with all these things, you have to find somebody like that. Direct is not a solution. Okay. Regular is not a solution either. But having someone to guide you through your investment journey, through the journey and after that particular destination, that is where I think you need to take a call, is what I think, Mr. Lalit.
On that note, I want to sincerely thank you, Dr. Balaji sir, for sharing his thoughts with us. Our audience was deeply impacted by your knowledge and insights, sir. Once again, thank you so much, sir, for sharing your time and expertise
Thank you so
with
much.
us.
Thank you so much.
Thank you. Thank you. I hope you have an amazing day. Thank you.
Yeah, thank you. You too. Thank you. Thank you, ma'am. Thank you so much.
Yeah, and also thank you to all the attendees who joined today, and your
It's very important.
participation
Yeah,
and
yeah.
their participation and presence really added a significant and impact to the session, right? Yes. So thank you all for joining today. Thank you. Thank you.
Bye-bye. Thank you.
Thank you, sir. Now I request IT team to close the session.